Hello and welcome to MedCity News' Invest Conference. I am Orundhuti Parmar. I'm the editor-in-chief of MedCity News. I do hope you're including us as amongst your sources for healthcare news and healthcare innovation news especially. So today we are gathered here to listen to a panel discussion on trends in healthcare investing. Now we're seeing that there are sky-high valuations. There are SPACs that are wreaking some level of havoc in the marketplace. And of course, the capital markets themselves are flush with capital. So what does all of this mean for healthcare investing? What does it mean for startups? We've assembled a great panel here today to discuss these very topics. I will begin by introducing them. First, we have Liz Rockett, Director of Kaiser Permanente Ventures. She's our intrepid moderator. She's an investor in health tech and tech-enabled services at Kaiser Permanente Ventures. She leads the fund's impact work and is a leader of its diversity, equity, and inclusion revisioning. She serves on the boards of Big Health and Everytable as a board observer to groups DexCare and Omada Health, and as a member of the investment committee for Rock Health. Prior to KP Ventures, Liz ran health impact investing for Imprint Capital, acquired by Goldman Sachs. Before her work in investing, Liz worked in new product development and customer success at the advisory board company, which was acquired by Optum, Trezetto, and Outcome Sciences, acquired by Quintiles. She has a long-standing love of all things career development, talent strategy, and team culture. She is a proud alum of Princeton University undergrad and the University of California, Berkeley, MBA and MPH. Welcome to you, Liz. Next, we have Sahil Choudhry, Managing Director of Cigna Venture and Strategy. Sahil co-leads Cigna Ventures and helps inform strategic decisions for the parent organization. He joined Cigna in November 2019 and currently serves as the board observer at Ginger and Octave. Sahil previously held board seats at Cogitativo and Solera Health and observer seats at Clear Data and Avalon Healthcare Solutions. Previously, he spent 5 years at Healthcare Service Corp, managing corporate development and venture investments for the largest customer-owned health insurance company in the country. HCSC is the Blue Cross Blue Shield plan in Illinois, Texas, Oklahoma, New Mexico, and Montana. Sahil holds a BS in mathematics as well as computer science from New Jersey Institute of Technology. He is an associate of the Society of Actuaries. Welcome, Sahil. Next, we have Amy Kobe. She's a principal with Baird Capital. Amy joined the company in 2018 and is a member of the healthcare investment team. Amy is a board member for Kala Health and a board observer for Jumcode Genomics, Upfront Healthcare, Oncology Analytics, Apurvita, and AI Cure. Before joining Baird Capital, Amy was a venture investor with Baxter Healthcare, focusing on medical devices, monitoring, and data analytics opportunities. Before that, she was with HealthBox, focused on tech-enabled products and services for payer and provider systems. She was also previously a management consultant with McKinsey and Company and began her career at Genentech. Amy earned a BS and MS in chemical engineering from Stanford University and an MBA from Kellogg School of Management. She is also a member of the Economic Club of Chicago. Welcome to you, Amy. Next, we have Garheng Kong, managing partner at HealthQuest Capital. Garheng founded HealthQuest in 2012. A physician, scientist, and engineer by training, Garheng has over 2 decades of experience investing in innovative healthcare companies with a long list of successes, 25 IPO and M&A exits. He's an Aspen Institute Health Innovators Fellow and a Kaufman Fellows mentor. Garheng received undergraduate degrees in both chemical engineering and biological sciences from Stanford while on an athletic scholarship. He then earned an MD, PhD, and MBA from Duke University. His early career included stints at GlaxoSmithKline, McKinsey, and a medical device startup, Therox, before joining Inner South Partners and then Sofinova Investments. Welcome to you, Garheng. And now I wanted to throw it back to Liz, who will shepherd this discussion. Take it away, Liz.
Hi, everyone. Thank you so much, Arundhati, for that introduction. Really appreciate it. And I am Liz Rockett. I'm an investor with Kaiser Permanente Ventures. and really excited for this session, particularly because I don't have to answer the questions, I get to ask the questions. I'm very pleased about this situation because we're going to talk about the investing market that we're all living in right now, which is a unique one. So I'm joined today by a great group, as you heard introduced. I'm going to ask each of them to just say a quick hello before we get into some of the conversation, to talk about, just give you a quick introduction to their name and fund, and then also just a recent deal that they're excited about. So I would love to start with Garheng, if we could start with you.
Thanks, Liz. Hi, I'm Garheng Kong. I'm with HealthQuest Capital. We're a healthcare-focused growth fund that we started about 8 or 9 years ago, investing across the full spectrum of healthcare, devices, diagnostics, digital health, tech-enabled healthcare services. And we've had the fortune of partnering with quite a few fantastic management teams, but the most recent company we partnered with is called Everlywell, and they are a home diagnostics business that's really changing the way people manage their own health. And so we're excited to partner with them, and hopefully you'll hear more about them going forward. Thanks.
Excellent, thank you. Amy, how about you next?
Sure. Hi, everyone. My name is Amy Lynn Kobe. I'm a principal with Baird Capital. Maybe a little bit about our fund. We're the direct investment arm for Robert W. Baird, a privately held investment bank based here in the Midwest, based in Milwaukee. We're investing out of our 5th fund. We announced the close actually just a little over a year ago today. It's a $215 million fund focused on technology and healthcare. And very similar to Garheng, we focus in 3 areas in healthcare: medical devices, tech-enabled products and services, and then life science tools and diagnostics. Typical stage of entry for us is late Series A, Series B, and while we are based in Chicago, we like to be opportunistic, and we'll certainly leverage relationships for opportunities on the coast, but do tend to focus, I would say, in kind of the middle part of the country and other underventured type geographies. But I will say one company that we're particularly excited about is Cala Health, one of our first investments actually that we made out of our new fund. The company has developed a non-invasive wearable neuromodulation therapy for essential tremor. The way it works is the patient will wear the device. It's really similar to a smartwatch, for example, but you wear it on the affected hand, and the device will measure the tremor and then send a personalized simulation from the nerves in your wrist to the spot in your brain to counteract the tremulous signal. And it's pretty remarkable. If you watch the video, you'll see a patient go from a pretty a debilitating tremor to being able to chop vegetables with a knife, tie a shoe, handwrite a letter, play golf. So pretty phenomenal. But we're quite excited for the company. They're developing a platform of devices to address a range of indications. So already very excited about that component core business. But on top of that, and I'm sure we'll touch on this later in our discussion, but on top of that, we really see the potential of the company as a data analytics play. So a lot of themes there in a real world evidence and personalization of therapy. So real excited, and woman-led as well. So really excited about that company.
Brilliant, thank you. And finally, Sahil.
Thanks, Liz. I am Sahil Choudhry with Cigna Ventures. A little bit about Cigna Ventures. We're Cigna's venture capital arm. Our first fund started in 2018 with $250 million from the parent. We're largely stage agnostic and invest in healthcare companies that are closely aligned with Cigna's strategy and mission. On a recent deal I'm excited about, you'll like this one, Liz, because it's also your portfolio company, but it is Ginger. Ginger delivers mental health care via access to coaches and clinicians virtually. They're solving an important problem. Most people who need mental health care in the country don't get any, and access and availability issues in mental health have only been exacerbated by COVID. Ginger is a great product and a great team, and we're pretty excited about what they're building.
Amazing. I second that, although I am a shill, obviously. But great companies all, and just a really exciting breadth within this group. So thank you all for joining us. I think, we're just going to dive right in. We're going to get a little bit into the exit activity that's been going into the market and some of the broader market forces as well. But first, certainly the thing that's on my mind the most is we're seeing so much capital deployed in our market, and also just so many changes in the underlying ecosystem that we invest in. We've seen prices for these companies, so the equity value of companies, really start to increase as, for a range of reasons. Curious, as funds and investors that have been in this market for some time, how do you think about value as you see these prices really shifting, and how have you kind of navigated for your fund thinking about kind of the right way to approach that? And Garheng, for this one, I'll start back with you. I promise I'll switch up the order though as we go.
Sure, no, happy to address it. It's really been a very robust market for companies in healthcare, and what we've seen is certainly valuations have continued to climb. Private companies that are comping to public companies have looked at metrics that have continued to increase, whether it be a multiple of revenue or growth rate. And so definitely more valuation inflation, if you will, arguably buttressed by the public markets as well as SPACs. The presence of SPACs have really changed the dynamics of what a company can get. And I think because of that, that has affected the dynamics of the exit market, which I know we'll talk about in a little bit. So, for us at HealthQuest, we tried to be disciplined about that because, a company that was trading at 10 times revenues for being high growth and now is trading at 20 times revenues, at some point it may go back to 10 times, and even if the company's doubled in scale, it'll be the same valuation. So, that's something that we are mindful of. And I do think that from a competitive point of view as well, that's also changed because more and more players are showing up. Maybe one anecdote before I pass it along to my colleagues here. Maybe we should have done this sooner, but recently we did a reverse pitch where the company had multiple term sheets and we actually scheduled a session where we actually pitched them on HealthQuest and the experience and ecosystem that we would bring to bear. I think that a lot of our IT brethren have been doing this for a long time, but maybe because of these dynamics, we're starting to have to do that as well. And in this case, it paid off because we ultimately signed the deal and apparently at not the highest valuation, but I do think it is a new dynamic that we need to be conscientious of.
I'm curious, Sahil and Amy, does that resonate, or are you all seeing sort of a different approach or different thinking within your own groups? Sahil, I'll let you go first.
Yeah, no, I think definitely resonates. I think like both of you noted, valuations are inflated in both public and private markets right now. And we've tried to remain disciplined and stay aligned to our financial targets. So, putting aside all the good stuff about large markets and growth and execution, when we think about valuations, we're sort of working backwards from when we think the company might exit and at what value. And when we do that, we're not assuming that prevailing multiples in the market today are going to be the multiples 3, 4, 5, 6 years from now, and are assuming there will be a reversion to the mean. That sometimes means we lose a deal or cannot join a syndicate, but that's okay. I will add that higher prices have been one reason that we've started to invest a little bit earlier than we used to.
Yeah, I would completely agree with my fellow panelists here. The pandemic has just put such a spotlight on key sectors, tools, diagnostics, of course, biotech, health tech. But I find the comments very resonant. we too have tried to, and we still define value, I would say, very similarly as how we did pre-COVID, and try to stay disciplined. Maybe one additional comment I might add to the conversation is that we have seen round sizes increase. And even ourselves, especially in the early part of 2020, we urged our management teams to try to raise, as much money as possible here to try to weather the storm. So I think that given, seeing that round size increase a bit, all the more important to stay disciplined and kind of underwrite to similar principles and foundational kind of, evidence of current and future traction, revenue, traction in the marketplace, addressing large markets, differentiation, significant unmet needs, and how the solution solves it specifically. So I think still playing back to the foundational aspects of the investment is kind of what we stay true to.
Thank you. Yeah. Go ahead, Garheng, please.
Just to add to Amy's comment, one of the things about fundamental investing, especially on the growth side, it's always been this balance between growing and in our case, getting to self-sufficiency, right? And so it's this balance of showing top line growth, but also not having to raise endless dollars to continue to fuel that. And we've never tried to invest in a company where day one you need to be instantly profitable, because then you can't really invest in the business. So it has always been a judgment call, but I think in this current environment, the weight on growth and addressable market is significantly more than getting to self-sufficiency. And so that's something that we've really had to balance in terms of encouraging our companies on how they raise capital, to Amy's point, and how much they raise, because you can access capital at a different price point now, and you're getting rewarded for that top line growth and not so much, getting to self-sufficiency.
And that it certainly goes to, Amy, you mentioned just the round sizes getting bigger. The question of sort of how entrepreneurs are able to access capital, where this market has been pretty predictable for some time before the moment that we're in now, right? Sort of steadily growing investment into the sector, but this has just been a step shift, and interesting to hear that what's being rewarded. I'm curious, when you think about the conversations that you're having with entrepreneurs and how you're guiding both within your portfolio and companies that you're meeting fresh, to think about, the amount of capital that you can access right now and how you might be able to think differently about your business if you do that. Garheng, we hear a little bit of the, self-sufficiency can still matter. It's something that hasn't necessarily been front and center in conversations lately, but I'm just curious, have you found any of those conversations with entrepreneurs, maybe thinking within your portfolio about the amount of capital that you can access, changing perspective on what kind of business folks might be able to build in the nearer term? Anybody have any examples of that of late?
I mean, we definitely have some examples where I would say companies, for example, who realistically, when we partnered and underwrote the investment, we thought would be a year or two or three from a potential public offering. But in this current environment, maybe they're a year from a public offering or 6 months from a public offering. And all of a sudden you have this dynamic where you have access to $70 or $100 million in IPO or 150. And it's a little bit of a double-edged sword, because you have it, but you also need to figure out what to do with it. And so companies are now fast forwarding their IPOs, but they're also fast forwarding their capital deployment plans. And that's forcing them to figure out how to effectively use that capital. And, I think it is a balance, because we've all been in situations where companies have been forced to take too much capital, and they don't always have a way to deploy it effectively. And so in those situations, we do worry about that as well. But for the most part, the balance has been, what can you do with more capital? What other markets can you pursue? What other applications of the technology is there? And and so it has caused our management teams to think more broadly about it.
Yeah, and I would echo that. I think there's the balance point. On one hand, you definitely want to take advantage of the market, right? If you are getting more capital at a high valuation, and you know you're gonna deploy that capital, it's prudent to take advantage of the market right now. At the same time, you have to be careful not to overcapitalize the company, right? In our experience, companies tend to burn more capital than necessary when they raise more capital than necessary, and it sort of sets the wrong incentives and expectations for the future rounds and exits, et cetera. So the balance there is key.
Yeah, I would totally agree. And I think this might take us on a little bit of an adjacency here, but I think one thing we did, especially in the early part of last year, was to have like, at least in the early part, it was like plan A, plan B, and then like nuclear winter plan. But then towards the end of the year, as some of our other companies started looking at financing, again, to the balance point that the other panelists were speaking about, then we started having, well, what does growth 1 and growth 2 plans look like? So just, I guess, being very thoughtful into where every dollar is going, but also to have several different plans that you can pull with given kind of predefined triggers, I think has just been really important to kind of this year, to weather this of this year, so.
Absolutely, yeah. The approach to capital funding and raising a year ago, just so different from the moment that we're in right now. And Garheng, looks like you were maybe going to add one more thing there.
I was just going to say that we need to, I think we also have to be a little mindful. If you look at the last few weeks of market activity, it has to be a moment for some consideration. We've had an unbelievable, robust healthcare market for many years now, and even through the pandemic, even more so. But I use the previous analogy. I mean, if companies trading at 20 times revenue and it goes back to 10 times revenue, I mean, historically, that's still a really good number. And we just have to realize that, and I know Sahil mentioned this, I mean, it will ultimately revert to the norm at some point. And so we have to be calibrated for that. And I think that we've tried to remind our companies that, the access to capital has been great, but it will not last forever, and we need to be mindful of that.
Any contrarians believe that these multiples might actually stick around for health tech? I mean, we know, like our tech brethren, my goodness, they seem to have an easier job than us in terms of some of what they get to expect for valuation on growth. But just curious if there's any contrarian views. It sounds like we're all pretty aligned with a little bit more conservative thinking about what might happen in the future. But just want to give air to it if it's out there.
So I heard an interesting commentary, not so much about whether or not across the board the health care companies multiples will stay at where they are today, but within healthcare, whether or not some of this is being right-sized. So for example, I think biotech has historically been, highly valued in a good market, and not really revenue driven, but more about potential. But let's just pick medical devices or diagnostics, for example. Has historically been more driven off of revenues, but now we're seeing tools and diagnostic companies and even device companies go public with sometimes no revenue traction or very little. And there has been an argument from some saying, why can't this be like biotech? As long as the markets are large enough and it's really an option value on the future, we should be comfortable with that. And so I think that's an interesting concept to say maybe that historically when tools and diagnostics were valued at 2, 3, 4, 5 times revenue, and now that they're obviously at a much higher number, that it doesn't actually have to go back to that historical stage. Maybe it'll end up, more anchored around, how we're looking at other healthcare businesses like biotech. So sort of a nuance within our healthcare sector.
Excellent. Well, maybe let's think about, because I know it was mentioned right at the top, both the public markets are rewarding some of this, and also we're learning a lot about just where that later stage capital to fuel further growth is going to come from. And so I'm curious, Sahil, I might start with you just because your organization obviously sits on both sides of this, both investing and then of course the parent organization has been a little bit more acquisitive of late. So just curious, when you look at the activity that we've been seeing over the past few quarters, what are you learning? What are you thinking about what the market is valuing? And just sort of the players who are really driving some of the market activity, maybe on the acquisition side first, how folks are thinking about that.
Yeah, happy to. I think there's both, public markets and private market activity in this. So public markets have been an important avenue of exits recently, obviously, right? So historically, there's been dearth of scaled healthcare services assets that trade on the public market, and that's beginning to change. And part of it's driven by how SPACs have made it less risky for companies to go public, and also by the demand for growth by public investors, like Garheng mentioned earlier. So, but that said, strategics have also become a growing avenue for exit. So most national payers today have a diversified services strategy, and they're willing to acquire a much broader set of companies than they were previously. So I think, even if SPACs were to go out of fashion, and valuations were to calm down a little, I think strategics will still be there to pick up the slack on exits.
That's helpful. I'm curious for Amy and for Garheng, is there anything else that you've been seeing in terms of sort of what are folks valuing? Sahil just mentioned that, the payers are starting to think in terms of more diversified service. I know you all spend a good amount of time in also not just health tech, but med tech and biotech. Anything else that you're seeing and thinking in terms of just how that exit market is starting to value these companies that are at an earlier stage?
Yeah, maybe a quick comment here to kind of build off of Sahil's comments. Certainly in this last period, we've seen biopharma and then diagnostics and tools do very, very well. Public markets, particularly for biopharma, and then actually a dual track, public and private for diagnostics and tools. Our sense, especially kind of more on the health tech and certainly on the device side of things, is that the total private, M&A value maybe wasn't as much as it has been in the previous years or hasn't been as robust. But our hope is, as long as the public markets remain open, as long as public sentiment, remains strong, and continued enthusiasm, from investors in these different areas, we hope to see that M&A activity increase, and then of course, hopefully prices continue to increase as well. But hoping a little bit for this rising tide lifts all boats aspect. But maybe I might point a little bit to the private side, at least for health tech and for device being a little bit not as enthusiastic or aggressive as it was for biotech and diagnostics and tools.
Yeah, I actually think that, being involved with some larger companies as well, it's hard to compete with the public markets and SPACs right now. I mean, strategics that are actually looking at the business and trying to figure out what it means to them from a actual nuts and bolts perspective, I think it's hard for them to justify and compete in many cases. I mean, of course, there's still deals that are going to get done, and by definition, there should be strategic value that they can garner that a pure financial investor cannot. But we have a similar sentiment as what Amy described, in the sense that the M&A is a little bit more muted because the companies have options to get valuations that probably operating businesses are not up for paying at the moment, and so that's changed the ratio, if you will. I mean, if you look historically at venture-backed businesses over 25 years, the exits are probably 80-20, M&A and versus IPO, but today it's maybe 50-50 because the markets have been so much more available to these private companies. So that has definitely affected the exit activity and where companies are going.
and Amy didn't know if you were about to say something, but please go ahead and jump in.
Yeah. I mean, one thought that was that kind of came to my mind, and a little bit goes back to the competition point that we were talking about earlier. I wonder if it is going to be very, very competitive to stay abreast with public markets and how aggressive they are. So I wonder if that may make, maybe Sahil, this might be a question for you, but if it may make strategic kind of transact a little bit earlier. I will say all of our deals last year were competitive, and interestingly, one of them, the competition was, of course, the VCs were there, but our primary competition was with strategics. It may have been the sector, it was a medical device, it may have been the sector, but it was just interesting to see the strategics interested, in an earlier stage than perhaps typical. But I wonder if we might start to see more of that if the competition really is so much at the IPO level that they might try to look a little bit earlier upstream.
Yeah, and from a venture investment perspective, it's definitely done that for us. I think the jump we started to see from Series A and B to later on was just massive. And if we found that we could, get comfortable with the risks of a Series A company or a Series B company, we have moved earlier from that sense. But as we think about competition, I think if you don't want to compete on price, you're competing on access and value add and expertise, et cetera, which we think is all linked to brand and reputation. So, continue to work on that. I think for us, one obvious thing founders are hoping for when we invest is a contract with Cigna, pretty simply, right? And we've had a great hit rate on that front. We have a dedicated team that supports our portfolio companies get through the maze of payer contracting. So we work hard on, I know it's a cliche, but we're working hard on delivering the value add where we can, and just continue to work on our reputation. And we encourage, every time we're in the pipeline, we're encouraging entrepreneurs to reference check us, and it's becoming more and more common for them to call our other portfolio companies. But yeah, I think to your point, we definitely have moved earlier, largely driven by price.
And I'm curious, Sahil, before I let you out of the hot seat, have you seen Cigna as an acquirer starting to think and talk about even acquiring at an earlier stage? I know that the MD Live transaction was just recently announced. They're pretty, in our world, established business, but any shifting in terms of that thinking rather than having some of these folks go public in that diversified strategy?
No, I think that comment is pretty limited to our venture strategy. I think our acquisition strategy for our parent is closely aligned to our strategy, and hasn't moved earlier, I would say. But I think the previous point Garheng made around public market valuation certainly makes it difficult when we ourselves can't justify what a company could get in the public market. So that's definitely been a challenge.
Appreciate it. And so we cannot have a conversation, a panel in this moment without talking about SPACs. It's essential. So I'm curious for you all, clearly SPACs have created a different and sort of worth considering path to getting public. And I know some of the boards that my group sits on, we're having conversations about kind of where that makes sense and how folks should think about it. I'm sure we're all getting the same education, but I'm just curious for both broad perspective on kind of what is this going to mean for how the public markets might receive health tech in particular. To some extent, biotech and med device, I think are going down similar routes, but would love to know how you're thinking about it, how this will impact the public markets overall, but also just more specifically, has anyone here actually participated in any, considering it, looking at it as a good, you don't necessarily have to name names if there's a deal that's live, but just curious if anybody's had a front row seat to any of this. We haven't yet, so curious to learn from anyone who has. If you all stay on mute, I'll assume you haven't. Okay, so go ahead.
Yes, I mean, putting aside the SPAC structure and incentives and what it means for the investors on the other side, it's definitely created a new and easier and accelerated path to go public. I know it's not new, but accelerated and easier path to go public, and that that it's helped remove some uncertainty for companies and that usually exists in a normal IPO process. So selfishly, as a venture investor, I think that's just another path for exit for us. I think there are obvious issues around structure and incentives for the SPAC sponsor and to promote, but that's another topic for another day. But that's how we think about it. We have not considered participating in any SPAC, to your question.
I would say we're largely in the same boat. There's just so much interest. Again, maybe it's pandemic driven, but around biopharma, diagnostic tools. There's even like a sustainability ad tech angle for us. But I would say it's top of mind for a couple of our companies. Mostly ones that are raising larger financing this year. But even those that are one round away are starting to have introductory conversations, trying to understand and starting to dip the toe. But I would agree, we see it currently as added optionality, urging our teams to kind of parallel path the conversations with existing kind of traditional exit conversations. But certainly, I would say as of today, still in information gathering mode, but certainly evaluating as an option. I think speed and perhaps an easier road, but still wanting to evaluate the cost of it versus the traditional route, I think may end up being our point of evaluation.
Yeah, look, I mean, we've talked to most of the banks about it, and they said, hey, how come you haven't done your SPAC yet? So we have thought about it. In some sense, there's just a lot to do, so we haven't gone around to trying to put one together. We have had companies on the receiving end of SPAC offers. And for whatever reason, we've actually never consummated one, either because they decided to go public, or we've had a few companies actually get acquired by strategics in the first quarter as well. But I guess both Amy and Sahil mentioned this. From a private company point of view, it's a great thing, right? Because it's another buyer at the table, and to be fair, they're usually more generous when it comes to pricing, and so it's a group that can add strategic value, but has a clock on when they can actually invest. And so once a SPAC gets into months 12 to 15, usually they're pretty motivated, and that's favorable if you're the target company. So we actually think it's positive from an individual company point of view. Now, if the whole thing blows up because the de-SPACing doesn't work over time, then that will be a net negative. But in the interim, having essentially more strategics around the table is great.
Excellent. Well, I know, and I appreciate that. It's something that I think we're all kind of feeling out, just getting nuanced in our understanding of kind of what that path means. I did want to make sure that we take a little bit of a step back. I mean, I think when I wrote these questions, which was long ago in mid-March, I was starting to think about the end of the pandemic, which I work for a health system, like I should know better. But as we're now hearing news of a possible fourth wave, I don't know how to think about that. But on the hypothetical that there will someday be a day when people are more like out in public life and things are a little bit more fluid, folks are vaccinated, all those things. Some of this for the underlying things that have driven a lot of the activity in the markets that we invest in is likely to shift. So I'm just curious, as you all think of that, I've heard some of the sort of talk about discipline, talk about just sort of keeping, being thoughtful about how valuations and all that might change. But when you all think about the markets that we're in and, sort of society going through potentially another change as we, I shouldn't say this because I'll jinx us all, but come out of a pandemic, what are you watching for, and what are some of the things that, whether it's sectors you're excited about or sort of signals in the market that you're going to be cautious about for your own portfolio, anything that you are watching? I think the audience would be really curious to hear about. And I will, Amy, I'll start with you.
Sure. So maybe I'll take part of that question. I would say I would say sectors that we're interested in. Generally, I think the themes more or less will actually be fairly consistent, I think, with pre-COVID, but I would say maybe with just some additional layers and bells and whistles added on top. So as an example, even pre-COVID, remote care and alternate sites of care was always very interesting to us. But certainly an example, maybe tech-enabled product or service that might enable a remote or alternate site of care. Certainly with the pandemic, now accelerating virtual care, for example, that might be a lens that we would add on top of this theme. And then maybe kind of in a similar parallel fashion to that, another area that we've been interested in before and continue to be interested in is the digital transformation of healthcare, particularly for health systems. And of course, again, not new news to anyone and not a new idea, but certainly accelerated by the pandemic. So for example, something that comes to mind is perhaps, how as a patient might move through the health system now post-pandemic, moving from different sites of care, moving from perhaps a digital experience to an in-person experience back to digital. How might a health system better provide me a seamless, more optimized experience? Now with outreach, for example, I get text messages now from CVS, for example, for a COVID result, things like that. So how in the future am I going to have personalized outreach, personalized education, personalized navigation to make sure that I get the right care at the right time at the right site? So I think consistent themes before and after, but maybe just this an accelerated push or an accelerated lens from the pandemic. I'll pause there.
Thank you. And Sahil, maybe we'll go to you next. Are there similar, different things you're watching for?
Yeah, similar. I was starting to think that Amy was reading our strategy docs, but so the obvious one that everyone I'm sure has thought of is virtual, right? So I'll move past that, but the second one that Amy was talking about, site of care optimization, I think particularly home health for the elderly is interesting, right? So I think even before COVID, last place a senior wanted to be was a nursing home, and I don't think any of the COVID stories have helped that. So we think this will continue. That's a space we're interested in. I think it will eventually lead to rising demand for home health aides. The other two I'd point out are more of a wish list than a prediction that I think COVID may drive. We hope it drives. One is just addressing racial and structural disparities in health. So we've known these disparities exist. COVID highlighted them even further. But as you look at what's been built, we've been building one-size-fits-all solutions for too long. So we hope, and I think we think it's time to start building for underserved populations. The next one, the next one is also something we've all been talking about for a long time, and it's increasing role of non-physician resources like nurses and pharmacists, right? So talking about it for a while, but we just haven't seen significant movement. And I think partly because it requires movement from state legislatures and state medical boards. But even though these trends have been evident before, COVID highlighted a lot of them, and we hope we'll start to see solutions in those areas.
Yeah, I think that both Amy and Sahil's comments resonate with me. The first about a lot of the trends are not changed. Just the timeline acceleration piece, I think, is certainly the case. I mean, video conferencing existed, but we're doing a lot more of it now, for example. So I think that's probably the central tenet. There are some things that maybe have changed in a step function. And for those who have been ill before or chronically ill, they are somehow more in tune with the health system because they've had that experience. This might be the first time where the entire population has been forced at the same time to deal with the medical issue. Even if you were otherwise healthy, the pandemic has caused you to think about your health and getting tested and so forth. And so I think that the conscientiousness level, if you will, of the entire population around health has risen. And that leads to more on the margin at least, more proactive addressing of your health. That of course speaks to remote monitoring, that speaks to home testing, that speaks to telemedicine, all that stuff as well. But I think the baseline mentality of the entire population has changed now, because literally it's everybody's problem now. It's not somebody else has this problem. You know, everybody in society has had to deal with the fact that there's a medical issue. And so it's put that on the forefront, whether it was priority number 1 or priority number 5, it's moved up the list a little bit. And so people are thinking about that. You know, from a specific areas of healthcare, you know, this concept of moving medicine from the hospital to the home, and maybe the office in between, that's continued to be the case. I think more efficiency, there is a shortage of physicians, a shortage of providers. So anything that increases their productivity, whether it be extenders or technology or care coordination or communication, all those tools and attributes I think will be important, because we will have a finite set of resources that just have to be more productive. And so looking at either new models or new technologies to deliver that is something that we continue to be interested in. And then of course, on the more, I'll call it wet science side, whether it be diagnostics and looking at biology, that information continues to grow and expand. And now we're getting to the point of, you know, predicting which patients will develop AFib, certainly the cancer piece as well. I think when you have that kind of information, there's a significant burden of responsibility in terms of what to do about it. And so taking that, I call it data, and converting it into information, I think will be really valuable going forward as well. So a few areas to consider.
Excellent. Excellent. And one thing actually, Sahil, one of the areas that you were mentioning of just sort of thinking about underrepresented populations, it made me think one other thing that I'm just kind of curious before we wrap up today to just hear from each of you, you know, one of the, you know, just the major trends or trends is the wrong word, things raised to the public consciousness of the last year have been diversity, equity, and inclusion. And the point has been made repeatedly about just the impact that each of us in the seats that we sit in, both as venture investors as well as board members of companies, so sort of who we choose to invest in, what types of companies we choose to invest in, as well as how we operate in governance within companies. You know, for my group, it's been a point of exploration, trying to figure out where we can get stronger and smarter. But just curious for you all, you know, has this been in the conversation, and is there anything that you'd reflect back to the audience in terms of what's important, or what's newly in focus, if anything, or what's always been in focus and you just like a chance to brag on it, because we'll take that too. But Amy, I'd love to start with you if there's anything. And yeah. I didn't give you all a prep on this one, so sorry for putting you on the spot.
No, absolutely. It's a topic that is super important and has been front and center. It always has been, but I think certainly now more than ever. Maybe I'll give just a little anecdote. So our fund is divided into healthcare and technology. So this is actually an anecdote from our technology side, but their deals have been ultra competitive, maybe even more so than our side for a while, and certainly over the last year. But we ended up winning one of our most highly competitive deals because our investment team, I mean, his exact words were, I looked on the Zoom and I saw diversity of faces, and I decided that you know, we really hold that very dear in our hearts as we build our culture and our company, and I wanted that reflected in who I work with, and from customers to vendors to my board, and you know, it's something that we've certainly taken to heart, but again, just now more than ever. So you know, I would say we are too kind of a little bit in kind of thinking about how to systematize it, but certainly it's always a topic that's front and center. It's how can we be better? What should we be doing? But again, a very important topic that we're very passionate about.
Yeah, maybe again, it's a really important topic, and obviously something that is not just critical for society, but also for the progress of innovation, because I think that having disparate perspectives and backgrounds in the mix ultimately results in a better outcome for everybody as well. Again, unprompted, but now that you've raised the question, at HealthQuest, for example, we started something, I guess it's been a while now, called Project Pulse Check, which is focused explicitly on underrepresented CEOs and founders. And so, as everybody on this panel knows, time is precious, and we get a lot of inbounds, not all of which we can spend time with and meet. But this effort is any underrepresented founder or CEO, by definition, we will spend time with to try and consider an investment or certainly provide feedback that might help his or her business. And we're actually trying to expand that effort with a few other partnerships as well to try and encourage that next generation of founders and CEOs that are typically underrepresented in healthcare. So that is something that that we've been spending time and effort on.
Yeah, I mean, look at this panel. Looks like we're maybe making progress. I think that the point I would add is maybe it's even more important in healthcare. I don't know if that's the right word, but if you think about who is the decision maker in healthcare, if you think about which communities are afflicted by what conditions, I think it's even more important for us to consider it. But we've had lots of conversations, and we're talking about potentially how we can deploy capital towards represented founders as well, in a similar way that Garheng spoke about. So more to come from us on that, but definitely a focus, and both for our own internal teams and for the founders we invest in.
Amazing, thank you all. It's heartening to hear, and I think just exciting to know that given that it's up for so many of our funds, it's a worthy conversation to have amongst ourselves and also with the entrepreneurs community, certainly. So thank you for that. And I think, as we wrap up, I would love to just hear one more thing from each of you, which is just what is one thing that you thought you knew about healthcare investing before this pandemic started that it turned out you were totally wrong about? And so for this, I will start, Garheng, with you, and we'll go down the line.
Yeah, it's hard to only pick one. I'll say I might actually pick two, but so a couple. Maybe I will pick two. So one is the definition of medically necessary. So I think that we had invested in companies that we thought were sort of real critical medical procedures or diagnostics or interventions. But what we learned early in the pandemic is that if you were not going to die that day, it got pushed, right? You would think if you need your heart valve replaced, that's medically serious, but we learned that those things got pushed for some periods of time. And for sure, if you're going to get your hip replaced, that definitely got pushed. So what was considered medically, necessary and really critical got deprioritized quite meaningfully during COVID. And so we recalibrated ourselves as to what is something that a patient, a physician, or a health system has to have. So that's one thing. And then maybe the other is more of a tongue in cheek about how many times I've been wrong. But in March, we didn't have a crystal ball, but we had some early visibility given some of our relationships. I had a discussion with our team and said, this is what's going to happen. The whole world is going down. The public markets will react instantly. But the private markets, they're just going to take a long time to react. Nobody's going to raise money. They're going to hold their breath. Every insider is going to try and extend it out so that people don't have to raise capital. But we've been through this in 2000. We've been through this in 2008. And 6 months or 9 months from now, at some point, the company is going to have to raise capital, and they're going to be really attractive situations. Lo and behold, I was right for 3 weeks, and then the public markets came zooming back. The private markets never changed, and we had to change our thinking completely because not only were there no good deals to be had, the prices just moved up in the middle of the pandemic. So we definitely had to recalibrate there.
Amazing. Amy, I think Garheng, 100% of us, I think, are on the same boat for that second point. Amy, over to you.
Yeah, sure. Garheng, your comments made me laugh because it just could not be more true. I think literally it was 2 weeks. It was from March 15th to the end of March when we were frozen. And then after that, everything was fine again. So it just makes me laugh to think back on that. But I would say one thing I thought I knew that turns out maybe was wrong about was that we are actually able to close a deal without meeting face to face. Certainly we'll probably go back to some sort of hybrid, but I think pre-pandemic, honestly, I think I would venture that was unthinkable. I mean, we put, and still do, I think a lot of emphasis on, shaking hands, meeting face to face, walking the halls, sitting down, having that kind of 3 to 4 hour meeting, even like dinner the night before, just making sure that you like really get to know a person, build the relationship. And so much of that, clearly is great to do in person. And so we thought, at the beginning of this, oh boy, we're not going to be able to meet people in person. This is just going to halt our business. But interestingly, I mean, technology really accelerating. We ended up closing one deal and beginning to end without ever having met anyone. But I would say lots of hours of Zoom calls. So maybe, in fact, more on an hourly basis, more face-to-face time with that respect. But that's certainly something that I thought would never happen, that we may kind of find some happy middle ground moving forward.
Yeah, that's so true. I never suspected this many people would see this room in my house. But that's so true. And Garheng, you pointed out at the top, just video conferencing was always around. It just took all this for us to realize how well it could serve us. Awesome, thank you. And Sahil, we'll give the last word to you.
I'm thinking back to the presentation we made to our IC back in March, and every slide was probably off the mark, but where we mentioned everything Garheng and Amy just mentioned, but maybe to take it away from COVID, I think I used to believe that employers are very price sensitive when it comes to digital health companies, and thought it would get even more price sensitive during COVID. And while that's probably still true on average, it's also true that there's a subset of employers that are willing to pay what I used to think were very high prices, PMPMs or another price model, for best in class assets. So, and it turns out you can build sizable companies with just that subset of employers. So it remains to be seen if I was at least partially right, and when these digital health companies reach that part of the market, whether they'll see pushback on pricing or not. But sort of danger of applying averages across the market. There's I was surprised by a number of deals and how big and how much traction they had at the prices they were selling at.
Amazing. Well, Sahil, Garheng, Amy, thank you so much. What a pleasure to get to talk to you all. This has just been a lot of fun for me. Thank you for answering a lot of the questions I've been wondering about for the last year. And I did want to give a shout out. The question that I asked you all at the end of what's the thing you thought you knew that you were wrong about is I stole that from a marketplace podcast called Make Me Smart. So we'll have to submit all of your entries to that show and see if we can get you on the air over there. But for today, thank you so much. Thank you to the whole MedCity audience for tuning in. We're glad to just get to share this with you all, and thank you to MedCity for pulling us all together.
Thank you so much, Liz, and to all of you on the panel for such a wonderful discussion. My big takeaway was that just because you can raise a ton of capital doesn't mean you should, because when you raise more capital than you need, you tend to burn more, which is not what VCs want. So thank you so much. Again, this was a fascinating discussion, and thank you to all for watching.